Both of these stocks have fallen by 20%.
While nearly the entire market has taken a hit, some stocks are still holding fairly strong.
Held its ground completely strong.
MarketBeat's Gabriel Ossorio-Mazilli shares a list of 3 stocks he believes are buy opportunities during this falling market.
More momentum buyers, more institutional capital seeking that flight to safety.
He'll also share his list of 3 down stocks that he believes are too dangerous to get into now.
Everything that is being planned might take a few years, maybe half a decade. Can investors survive that long with the uncertainty?
Let's dive in. Gabriel, what a wild week in the market. Friday starting out down massively again after what was already one of the worst days the market has seen in years. What should investors be doing right now? I think that's everyone's question when we see this big of a drop.
Right, it's been a roller coaster of a week, as you just mentioned, because of the new tariff rollouts by President Trump and now a recent retaliation on the part of China, a 34% on top of what they're already charging the United States. So I think investors should take every piece of news with a grain of salt because we're in what's known as a phase one of these sort of events where the market is going to take a sharp move lower and then a sharp move higher, and it's going to go back and forth with every piece of new information that comes out. So being specifically picky about the stocks that you choose for your portfolio is going to pay off in the coming months, if not years.
The volatility is so true. That's what we're seeing right now and have been seeing for a little while. So I think it's important for investors to know the volatility is not over yet. It's kind of impossible to know what is yet to come, but there are still some buy opportunities out there. And there are certainly some stocks to stay away from right now that are going to have even worse volatility for maybe a longer time period than some of the other stocks we're going to talk about. So Gabriel, let's get right into your list first, talking about 3 stocks that are buy opportunities on this dip. And later on, stick around to the end of the video. We're going to talk about some of the worst performing stocks that really probably won't see a rebound for a while. You don't want to miss the last pick on that list. All right, Gabriel, go ahead and start us off with your first stock that's still a buy opportunity even in this down market.
Well, the first stock in this list, I would say focus on the value. Focus on companies that can pass down benefits to their consumers and that are focused in the United States, first of all, and that don't have to source the raw materials or their products from these nations where we're implementing tariffs upon. And that would be Chipotle. Chipotle sources most of the food from the United States, like chicken, beef, and other protein sources, as well as its avocados for guacamole, right? Everything comes either from the United States or Mexico. And if you noticed, President Trump never announced any tariffs on Mexico or Canada. It seems like everything is focused on the Middle East, Europe, and Asia. So all the tariffs that were announced previously to the Liberation Day, as far as Canada and Mexico, those are set. They haven't been changed. And it looks like he wants to bring the supply chain and production chain from Asia to North America. That includes the United States, Canada, and Mexico. At least that's the story that everyone's covering right now. So in that case, I think that Chipotle could see a much better positioning in today's economy, especially if, like I said, those raw materials, products, and food sources are coming from quote unquote tariff-free countries. So more than that, Chipotle has a lot of growth still. It's a company that has gotten through its growth spur successfully. It's creating a lot more free cash flow every quarter that comes out. And as you know, free cash flow can compound into more and more returns for investors, which translate into a higher valuation for a stock. Investors are worried about inflation, whether tariffs are going to bring inflation, whether a potential rate cut. By the way, the market has priced in 4 rate cuts for 2025 now. If that comes through on top of tariffs and inflation ends up being the end scenario, I think people are going to look to Chipotle as an affordable escape, an affordable lunch break. Now that people are going back to the office, now that people are going back to platforms like Uber and DoorDash as well, financing deliveries and whatnot, right? So I think Chipotle, due to its popularity, due to its market penetration, and due to its ability to pass down not the cost, but the benefits to its consumer, I think it'll be a stock that people should watch out for during this volatility.
Yeah, and Chipotle has had a really good run. This stock has been going up for the last couple of years. It led to that really big stock split they did just last summer. But now the entry point is quite a bit lower.
The stock right now it's at levels not seen since August of 2024. That makes it a 70% of its 52-week high, which is deep into bearish territory. Of course, you have to differentiate whether the stock is down by its own merits or whether it's the effect of a broader market sell-off, as we've seen this week on Liberation Day and further tariff announcements. And I think it's the latter. I don't think there's anything negative coming out of Chipotle other than the chart itself. But again, there has been support. This is the third time now that this price shows a little bit of a rebound. So to me, that's willing buyers coming into the stock, and you can see it in the institutional buying as well.
Yeah, I think you're absolutely right. The dip that you're seeing in this stock and a lot of the dips that we're seeing, it's just a market-wide situation and not necessarily anything to do with the company itself. And that's also the case with your second buy list right now, even in this dip.
That would be Pepsi. Pepsi, as you know, it's not only soda pops and drinks, right? It's snacks and they're going into the healthier route as well with acquiring some of the supply chain and equity stakes in Celsius. So they're not only going X growth, they're also going for that offensive, aggressive potential growth exposure through Celsius. So Pepsi is on the defensive side, right? The brand itself, the products that they sell. And most of them, right, they're manufactured again in Mexico and some parts of the US. So all the Asia exposure that they have, I think that those are going to be brought back into the North American market based on these tariffs that the President Trump is announcing. So with this in mind, the stock should never be this low, right? Right now, it trades really close to its 52-week lows, and it's a low beta stock. Low beta stocks, they're known for being a defensive safe haven that don't fall along with the market. But Pepsi right now is an exception. And just like Chipotle, I don't think that this is a company specific issue, but rather, like you said, a market wide systematic sell off that, like it or not, are going to affect stocks like Pepsi because ETFs and pension funds and momentum managers have to sell it along other holdings, not because of loss of confidence in the company, but rather because of systematic momentum loss into the bearish side.
Yeah, some really good points about what's going on with Pepsi stock today. And actually, I think the stock is performing pretty well compared to the rest of the market in this last 2-day downturn. Let's take a look at how much it costs to get into Pepsi right now and how much of an upside analysts are expecting.
Well, right now, you can get Pepsi at around 83% of its 52-week high. And while it's not the bargain hunt that a Chipotle or other names might be today, it has been outperforming over the past week, if not month, which is impressive considering the size of the sell-offs that we've seen in the S&P 500. More than that, investors can count on the stability that can be had through the stock's 3.7% dividend payout today. That is the benefit of backing up a company that is in the defensive sector, has a low beta, and the business model itself allows management to accurately and stably predict the free cash flows of the company so that they can keep affording and keep paying, if not increasing, the dividend payouts that are seen today.
Yeah, Pepsi is a great defensive stock pick to buy on the dip, even though it's not as big of a dip as some other stocks out there. And that's the case for your third pick.
Right. And when we talk about defensive, what's more defensive than a phone bill? I mean, people will stop paying their delivery obligations first than a phone bill. They'll stop paying their car or even a mortgage before they stop paying the phone bill. And I think that's where T-Mobile stock comes into play. Not only as a business model, which is based on subscription that allows for forecasting and stability of cash flows, which, trust me, is going to be the most important factor in the market coming up in this volatility. But it also has outperformed in a week where the S&P has fallen by so much. And that is why I think more momentum buyers, more institutional capital seeking that flight to safety or those safe haven names might start looking at T-Mobile. And also, you could see analysts from Benchmark as recently as March 2025, boosting the stock's valuation and reiterating their overweight view on the stock. So I think that as far as the fundamentals go and as far as the technicals go, T-Mobile could be one of those names that investors wish they had in their portfolio when the market goes as crazy as it has gone in recent weeks.
Yeah, and I think it's important to mention it too, just how well this stock has performed in the last 2 days while the rest of the market has fallen over 4% and over 4% again. This stock held up better. Talk about the entry point that it's at right now.
Well, the entry points could be right here. I think that a 10-point decline, even a 5-point decline from today's price could be an entry point. You could see the stock channeling for the past month as if expecting the S&P to break out into a down channel. And T-Mobile has held its ground completely strong. And from here, that only means that the breakout of the channel could go one or two ways to the upside or to the downside. And considering all the fundamental factors that back up a stock like T-Mobile, I think the probabilities are lying for the upside instead of a downside move in T-Mobile. So right now would be a fair entry. And as far as the analysts see, there's about a 15 to 20 point upside from where it trades today. Nothing that should be taken for granted during a time where the S&P is selling off as hard as it is right now.
Absolutely. And I think there's a temptation when you see some of these stocks on sale, some really familiar names out there, to want to buy the dip. But there are some stocks that you do want to stay away from. And we're going to get to that list in just a second, including one of the biggest stock drops we've ever seen in the market. That's going to be the final stock we'll talk about today. So stick around for the end of the video. First, I want to talk about our latest free premium report you can download right now from MarketBeat. It's about 5G stocks, and the path forward is completely profitable. That's the T-Mobile and other cell companies that we were just talking about as good defensive stocks. You can scan this QR code or click the link in the description of this video, and you can download that free report right now. All right, Gabriel, let's get to the second half of this list in this video, and that's the stocks that you do not want to buy on the dip. Which is your first company?
First one would be Nike. As bad as it's been treated, I don't think that the downside story is over with. Most of these products, apparel and shoes and everything else in the sportswear industry, are made in Asian countries like Vietnam. And those were the target of most of the tariffs implemented by President Trump. So now the path forward is, are these companies going to bring back production to the United States? Or are they going to stay in those Asian countries and keep importing? Both of these scenarios would mean an additional layer of cost for these companies to keep operating the way they are now. Think about it. If they bring back production to the United States, that might take 3 years, 4 years, maybe 5 years. And until that happens, how are these companies going to operate under the additional costs brought from tariffs? I don't think that they're going to be able to push it down to the consumer as big as a brand that Nike may be. So I think that the downside moves are not over with. Even though Nike is a stock that we all know and love, it's a brand that everybody wears. Unfortunately, it's not going to make a lot of business sense under today's environment.
Yeah, I think you're right on that. The volatility in the retail sector is not over yet. From a consumer standpoint, there's been a lot of chatter about potential $400 Jordans and a huge uptick in the cost of these. But I think the uncertainty of we just don't know as a consumer or as a business what these tariffs are going to mean for the retail sector. And that's why you have a second retail pick on your list.
That would be Lululemon. And that stock is as exposed as Nike is to the supply chain shocks that are coming through these tariff announcements, right? Even worse, Nike at least has the international markets to lean upon, right? It has Europe, it has Latin America, and it also sells its brand in Asia. Now, Lululemon derives most of its revenue from American markets while bringing in most of their products from Asia. So I think that the higher exposure in Lululemon is going to make the stock be punished a lot more than Nike already has. But take it as a proxy. Lululemon is still above Nike, and I think that it could fall to the same levels, if not worse, relative to recent highs being made or even 52-week highs. Uh, Again, it's a brand that everybody loves. It's a brand that everybody wears in the United States, but unfortunately, it's not going to make sense unless you're buying it to then resell it at a more expensive price because that is what you're going to be paying when these tariffs come along.
Absolutely. And I want to go back and look at the stock chart for both Nike and Lulu to talk about just how much of a drop these two companies have seen just in the last 2 days in the market.
Well, overall, you could pretty much take it as a certainty that they're deep within bearish territory. Both of these stocks have fallen by 20% from recent highs. And that's not even accounting the financial impact that might be had. Those are going to come when Wall Street analysts start to bring out their ratings, bring out their valuations, and potentially bring down their earnings per share forecast. And whenever that happens, you know what the impact on the stock price will be. And let me tell you, it won't be pretty.
Absolutely. I don't think the worst is yet to come for either of these companies. Let's get to the final stock on this don't buy list.
That would be RH. This furniture maker brings everything from Asia and still caters to the middle class and lower income class of the United States. Now, you have two major headwinds working against RH. One is the slowdown in building permits and housing starts for the United States, which are leading indicators for potentially lower demand in real estate. Then you have Buffett selling out his real estate brokerage arm of Berkshire Hathaway, taking a bearish bet on housing again. And now you have mortgages that, even though they're coming down on this sell off, they're still above 6.5%, pricing out most of the average consumer or average would be home buyer in the United States. So that's on one side. On the other side, all these tariffs are going to bring down the thin margins that RH already has even lower. That's going to translate into double digit, if not more, contractions in EPS and earnings per share for RH. And as you know, where that goes, the stock price follows. So after falling by over 57%, could be even lower by the time this gets posted. I don't think that the path forward for RH is looking any better than all these other retail stocks today.
Yeah, and I think I want to finish out this conversation by just talking about if there is a chance for recovery, how long off it could be for these retail sectors that are taking such a big initial hit just to the news of these tariffs, because truly it's completely changing the entire company's business model. How long could it take for these stocks to recover if they do at all?
Well, you have to look at the two potential outcomes from today's new information that's coming through the market. First, they could weather their storm and try to outweigh the tariff costs by economies of scale, by discounting their products, by trying to reach out to international markets instead of focusing most of their revenue in the United States. But how long can that take? And are they even going to be successful at it? I think that China is one of the bigger markets when it comes to retail, but they have their own brands and their own consumer have preferences outside of things like Nike, Lululemon, even when it comes to coffee. The Starbucks sales have been declining in China for that very reason. So I don't think that going international is going to be the fix. Then the other scenario would be bringing back production to the United States. And sure, the government could take some of the tariff income and subsidize the cost of making these products in America. But how long can that take? How long is it going to take to bring logistics back to the United States to build the factories, get the staff necessary to build these products, get the machinery requirements, energy infrastructure requirements? Everything that is being planned might take a few years, maybe half a decade. Can investors survive that long with the uncertainty and the volatility that's going to come with these stocks, not knowing where they're going to end up business wise? I don't think that the juice is worth the squeeze right now in the retail sector. And you can see it by the institutional selling of the XLY ETF, which covers the retail and consumer discretionary sectors as well. So smart money has been out of this sector. Warren Buffett has been out of these sectors as well. And like I said, it just doesn't make any business sense, any financial sense to start betting on these stocks right now.
All right, very good. Thank you so much for walking us through your list of 3 buys during this down market and 3 stocks to absolutely stay away from right now. Thanks again for your time, Gabriel. Let us know what you think. What's on your buy list during this downturn, and which stocks are you staying away from? Thanks again, and as always, happy investing.